happens when you're active in around-the-clock activity? When does your day begin, and how do you maximize its potential? Today we'll talk about the 24-hour financial market and how to utilize overnight premiums, or what brokers like to call swaps or rollover fees. The Forex market is open nearly 24 hours a day. In Europe, it starts on Sunday evening and trades continuously until Friday evening. At around 10 p.m. GMT, the currency markets get very quiet. U.S. traders are going home, Europe is getting ready for the night, and the Far East has not quite rolled out of bed yet. That only leaves Australia and New Zealand. Clearly, the markets are normally quiet around 10 p.m. GMT. At 7 Greenwich time, Asian traders are getting ready to call it quits, but the European traders are just getting started. Clearly, action-wise, it's best to find those times when the two markets overlap. But news is also a factor. These offer some interesting opportunities. There are 4 possible courses of action around key scheduled news events. For the UK, for example, you can either close your pound sterling trades before the news, open a new pound trade before the news is released, jump into a trade during the news spike, or try to catch the turn after the news spike. With currency derivatives, remember that over-the-counter instruments settle at 3 p.m. GMT on a daily basis. Look out for directional changes here. Financial institutions have a vested interest in the 3 p.m. expiration price, and they'll often try to move it. Another thing to remember is market liquidity. Trading at different times means different levels of volume. That means the number of participants trading at a set period. The more participants, the more liquidity. The more stable the market, and the easier it is to get in and out of a position. Market open times usually mean an increase in volume, as does market closes. That's why people may close positions or try to open new ones overnight. The result? A spike in volume. Then, there are also seasonal factors, such as a drop in volume as people go on holiday, or a spike in February to April when people are looking to get into long-term positions for the quarter or for the year. Finally, never forget trading data releases when volumes drop on account of people waiting for the results before committing. So in short, the trading day has many fundamental pockets of activity that can have a significant impact on an asset's price action. If you're aware of these special times, that can improve your trade risk management. Now, let's look at overnight fees. The reason these exist is so that we can calculate how much it'll cost to swap one day's cash flow with another. And we'll have to pay these charges whenever we leave a position open overnight. At AvaTrade, for example, overnight has been determined as 10 p.m. GMT, which is when U.S. markets close. The premium we pay depends on the size of our position. Most brokers will stipulate swap rates for a buy or sell position on each pair. But you can relax. The actual percentage is very small each night. It's the relative annual interest rates divided by 360. Now, it is possible to earn a positive sum each night too. For example, if we were buying the Aussie Swiss franc pair, we would earn a positive overnight sum, as we would earn interest on the Australian dollars we bought, and that's higher than the Swiss interest rate. In fact, quite often, buying currencies against the Swiss franc will result in a positive swap. Remember, all brokers are required to provide a table of swap rates that they base overnight fees upon. Once we have that, the formula is premium charged or earned equals the trade amount times the premium or interest times the number of days divided by 360. At Ava, they've already divided the yearly interest rate, so we don't need to divide. As you can see, we're talking hundredths of a percent. Hopefully, your assets movement will be much bigger.